Hey, hello everyone, guys. Hello everyone. Good morning. How are you all? Good morning, everyone. Good morning, guys. Good morning. Just please comment once about the audio and video of the class. Is everything is working good, working fine? Hi, guys. Good morning. Good morning, everyone. Audio, video, everything is clear. Audio and video, everything is clear, everything is working fine with all of you. Hi guys, good morning. So today we are going to discuss about this IEFS module D. This is factoring, forfeiting and threats. Trade receivable discounting system. There is trade, there is factoring, forfeiting, right? So we are going to discuss about this in today's chapter. So everyone, whoever is watching this video, it's a request that please like and share the video to the maximum you can. And if you haven't subscribed this channel yet, it's a request, guys, that please subscribe this channel and press the bell notification icon. Everyone, guys. Everyone, just hi, hello, everyone. Whoever is watching this video, just please comment once about the audio and video of the class. Is everything is working good, working fine, no issues? Okay, so today we are going to discuss about three most important things. This is the chapter where three things are very important: factoring, forfeiting, and trades. All things related to factoring, forfeiting, and trades, right? Trade receivable discounting system. So I'm going to tell you the most important thing related to this chapter, which is very important for from your exam point of view. For detail of this chapter, so we are running the JIB batch. There is an upcoming selection batch for all of you, which is scheduled and which is starting from 17th of January. So you can all enroll in that upcoming batch for the complete detail of this particular chapter. So let's start discussing about this. Okay. So let's start discussing. First of all, if we talk about the factoring is what? Factoring is an arrangement for financing a company's business against invoices raised on its buyer, and in which the factor is responsible for credit control, sales, ledger administration, and collection activities, right? So factoring is like a discounting system. So factoring is like arrangement of the credits, arrangement of a particular credit against the invoices which are raised on its buyer. So if there is a bill of exchange with the seller raised on its buyer, okay, for the arrangement or for immediate credit or for immediate payment against that invoices, factoring is the thing, right? So if we talk about the factoring, when we are talking about the full service factoring, the factor bears the losses if the buyer pays to pay. Because once there is a factor agent, the factor is responsible for credit control. The factor is responsible for sales ledger administration. The factor is responsible for collection activities. Factor is responsible for all these, right? But if we talk about the when we are talking about the bill discounting, the only the collection, or you can say sometime no collection is taken control by the discounting agency, but in factoring, the factor agent is responsible for all these things: control, sales ledger, and collection activities. When we are talking about the factoring is the factor has to bear the loss if the buyer has to or fails to pay. Means if there is a factoring thing, always remember, when there is a real or original factoring is concerned, then if the buyer defers on payments to factor, then the factor has to bear all the losses by themselves, and they cannot recover they cannot claim any compensation or cannot claim any reimbursement from the seller, right? So factoring is a services that is concerned with the financing and collection of account receivable, and this can be both in domestic and international trade, okay? And the agent or the financial institution who is giving this factoring services to the seller, that agency is known as the factor, and the process and the arrangement is known as factoring. When we are talking about the factoring, it can be with recourse and without recourse, but in India without recourse is not permitted, right? So with recourse and without recourse, everything I will be discussing in detail. First of all, just see this diagram, right? So I am going to discuss the whole thing related to the process of factoring from this particular. diagram, right? I'm going to explain you what is factoring by this diagram. Okay, so there is a seller. Look at here. There is a seller who sells any services to buyer and the buyer promised to pay, right? So instead of the immediate payment, okay, the seller just given a credit time period, like for example 30 days, that okay, you will give me money after this 30 days. And for formalizing this, the seller draws a bill of exchange on the buyer. When the seller draws a bill of exchange on the buyer, the seller says that you are responsible for paying me the certain sum of money after 30 days. That is the bill of exchange. Now, there is invoices and bill of exchange with the seller, which actually tells or will actually signifies that this particular person is responsible for the payment after 30 days. Now, this seller goes to what? This seller goes to the factor. Okay, factor is going, maybe can be any financial institution, this can be any bank, right? They goes to any financial institution, they goes to any bank and present the invoice there. Okay, because the seller wants an immediate payment. Okay, and now in this process the seller receives the payment which is offered by the factor, right? Now, after some time, the factors request payment, means, for example, 30 days is the time period. After 30 days, the factor represent that invoice to the buyer and the buyer pays to the factor. This is known as the process of factoring. Now, in the process of factoring, first the buyer is actually getting the immediate credit on behalf of the invoices. And second, when we are talking about this factor, when we are talking about this factor, factor is what? Is this factor actually receives the obligations, or you can say receive the right to collect the payment from the buyer, right? Now there are two things when we are talking about the two things. First is with the recourse. Okay, there is very important word, with recourse, without recourse. With recourse and without recourse, you will be listening this with recourse and without recourse in the complete chapter, plus in the whole PPP. With recourse and without recourse are very common. With recourse is when, see, when factor represent or request the buyer to pay, and if the buyer defaults on payment to the buyer. Okay, and if it is with the recourse, it means that factors can demand payment and compensation from the seller. Means the seller has to compensate to the factor because the buyer has default on payment, if it is with recourse. But if it is without recourse, now if it is without recourse, now in without recourse, what is the criteria? Without recourse says that now if the buyers default on payment on factor, now if buyer defaults on payment on factor, now the money is not recovered by the seller. Factor cannot demand repayment from the seller, and in this process the factor has to bear all the losses. And when we're talking about the factoring, factoring as an original concept is related to without recourse. It means that when the seller is giving invoice to the factor and receiving the credit, the seller is vesting all the rights to the factor. That the factor is responsible for collecting of the payment, the factor is responsible for managing credit control, and even the factor has to bear the losses in case the buyer default on payment. Okay, so this is the complete process of factoring. Now, in the factoring, always remember there is with recourse and without recourse. With recourse and without recourse says that if the customer fails to pay, customer is the buyer. If the buyer fails to pay, that the seller must buy back the receivable. Buy back the receivable means the seller gives back the money to the factor and take the invoice back, right? And if it is without force, it means that the factor cannot demand any repayment from the seller. Now in this, the factor has to bear all the loss by themselves, and that is known as with recourse and without recourse. Clear? Now, if difference between bill discounting and factoring. So the same thing is there when we are talking about the discounting. Yes, for the immediate credit, the bill of exchange is given by seller to any of the discounting agency and receive immediate credit. And then later when the money is there, the money will be managed and the money will be given back to the discounting agency, right? So for bill discounting and for factoring, what is the difference between these two? First of all, for bill discounting, strong balance sheet and collaterals are required. When any of the sellers present the bill of exchange for discounting, then you should have a strong balance sheet and you should have a collaterals. You should have to give collateral. With the invoices, you have to give collateral to the financial institution or to the discounting agency. But in factoring, if we talk about the factoring, it can be done with weak balance sheet. Factoring can be done with weak balance sheet. It means that there is no requirement that you should have a very strong balance sheet and no collateral is required for the factoring. Now, in bill discounting, it is always with the recourse. Okay, it means that if buyer defaults on payment to the discounting agency, then the seller is responsible for the payment to discounting agency. Whereas in factoring, it can be with recourse and without recourse, and originally the factoring is without recourse. Okay. Now, very important thing here, the collection is the job of exporter. Means the in the discounting, when the seller present to the financial institution for discounting and the financial institution gives the money. Okay, now the seller here gives the invoices plus collateral to the financial institution. Now the seller sent this buyer the invoice for payment and the buyer pays to the seller. Means there is the responsibility, the collection is the responsibility of the seller. Once the seller has received money against the invoices, the seller settles the payment with the financial institution. Whereas in this factoring agency or in this factoring thing, collection is always the job of factor. Factor is responsible for collecting management. Factor is responsible for the debt management and everything, right? So here the collection is the job of factor. Here the collection is the job of exporter, right? Now, financing is the transaction based. Here, financing is transaction based. It is based on account receivables and lecture. It is only a mode of financing. In bill discounting, you only receive financing, nothing else. Here, you will get the complete package. You will get the financing plus additionally you will get the management, you will get the collection, and even you will get the credit insurance, right? Now in bill discounting, because the collection is the job of seller, so there is no assignment of debt, whereas in factoring there is the assignment of. So this is the difference between bill discounting and factoring. The main difference is, just remember, in discounting the collection is the job of the seller, whereas in factoring, the collection is the job of the factoring agency. In bill discounting, you only receive financing, but in factoring, you receive the financing, management, collection, credit, insurance, each and every. Clear? Yes or no? Everyone, whoever is watching this video, it's a request, guys, that please like and share the video to the maximum you can. Everyone, guys, just please like and share the video. That clear? Now next thing is history of factoring. So when we are talking about the history of factoring, okay, when we talk about the where from where the factoring starts, okay, so in the ancient Mesopotamia time, there was the early evidence that there was credit and trade forms which are similar to what factoring, right? In Middle Ages, Jewish businessmen started in Europe for the trade purpose. American colony, early American colonies, yes, factors are the representatives of the European investors. 17th and 18th century transition to financial intermediary role. 19th century growth due to the industrial revolution and improved communication transport. 20th century formalization and proliferation of factoring companies. 21st, factoring as a multi-billion dollar industry with technological advancements. So when we are talking about the history of factoring, this is not very important. This I have just listed you that how, in which time period there was the steps of factoring, right? Now next, about the domestic factoring. Now, in domestic factoring, the receivables are arising only from the inland trade. Means whatever there is a bill of exchange, whatever there is a bill of exchange, okay, which are considered for factoring, the bill of exchange arises only from the domestic trade. Means when the buyer and sellers both are within the domestic boundary of India, and then it is present for factoring within India, then this is known as domestic factoring. Suppliers, borrower draws a bill of exchange. First of all, the very first step is the supplier draws a bill of exchange on the buyer. After acceptance of that bill of exchange, the factor makes a upfront payment of 80% of the invoice value, approximately. The factors pays upfront 80% of the invoice value, and this 80% is paid after deducting the discount charges, right? Now the balance of the 20% is paid when the collection is made from the purchaser. So when the buyer paid full amount to the factor settles the rest of the payment with the seller, right? Now the maximum, for what time period? The maximum time period for factoring is 150 days, and it actually includes the grace period of 60 days. So 90 plus 60, 90 days is the actual time period, plus it includes 60 days as a grace period, right? So domestic factoring, very easy. Domestic factoring says that the bill of exchange arises is actually from the inland trade. Inland trade means the buyer and seller, they both should be within India. When they both should be within India, then these are known as domestic factoring. Clear? Done. Now next, if we talk about the international factoring, what are international factoring? So international factoring is a financial arrangement where a business sells its receivables to a factor, but the transaction involves parties in different countries, right? Means there is a financial arrangement where business sells receivables to a factor, and that bill of exchange is involved when there are the parties which involve in two different countries. There is an exporter, there is an importer. So exporter draws a bill of exchange on the importer. When exporter present it's for factoring, right? Then it is known as international factoring. Now, what are parties that involved in the international factoring? First, there is a seller exporter who draws a bill of exchange and sells the good, right? Then there is a factor is always present in the exporting country, right? The seller presents that bill of exchange to the factor, and that gives immediate payment to the seller, and then the money is collected by the exporter, by the factor in the exporter country. There is the buyer, the customer who owes the money, and there is the factor in the importer agency. Sometimes there is an intermediary factor which is located in the buyer's country who manages the collection of receivables. Clear? Now, next is forfeiting. We have talked about factoring. Now, let's talk about forfeiting. Forfeiting is what? Forfeiting can be defined as a financing export by discounting export receivables evidenced by bill of exchange on promissory note, and it carries medium to long term maturity on fixed rate basis and up to 100% of the invoice value. Same thing is these discounting, forfeiting, and factoring, these are all same thing, but with a very little difference. Like forfeiting, when there is a forfeiter means any financial institution or bank who is giving you credit on the behalf of bill of exchange. Now, this credit is given at 100% of the invoice value. In forfeiting, it is given up to 80%, and the rest 20% is settled after the payment is received. But in forfeiting, 100% of the invoice value is given as a credit, right? Now, here the credit is medium to long term. In factoring, the credit was short term. The maximum days is 150 was 150, 90 plus 60 days time period. Remember, in forfeiting, there is medium to long term maturities, right? Now, when we are talking about the forfeiting, let's discuss first about what is the methodology for working of the forfeiting transaction. First of all, forfeiter gives commitment to forfeit to export. There is an exporter, seller, and there is an importer. Now, exporter wants that first goes to a bank which is present to its own country, or which is known as forfeit, and the forfeit promises exporter that I will be forfeiting, I will be giving you money on behalf of the bill of exchange. Once this promise and commitment is received by the exporter, then exporter involve themselves in the trade, right? Now the commercial transactions is made between the exporter and the importer. The shipment of goods is done to the importer. Now the exporter ships the good to the importer. Now the exporter submits all the document to the importer's bank through his banker. Now the exporter, there is the exporter bank and there is the importer bank. Now exporter gives all the documents of shipping to his bank, then the exporter bank gives it to the importer bank, all the documents of the shipment to the importer bank. When the importer bank obtains acceptance on the bill of exchange from importer, then importer bank co-accept it. Co-accept it means that the exporter banks just draws a bill of exchange on the importer that you have to make payment after 30 days, right? Now, this bill of exchange is sent to the importer bank, and when the importer bank take the acceptance of the importer in this bill of exchange, the importer bank just co-accept it. Co-accept it means in case importer defaults on payment to the exporter, then the importer bank is responsible for the payment of this bill of exchange, right? Now, exporter tender avalize the bill of exchange to the forfeiter. Okay, now here when the bill of exchange is completely accepted plus it is co-accepted by the importer bank, then exporter present this bill of exchange to the forfeiter. When the exporter presents this bill of exchange to the forfeiter, forfeiter makes payment to the exporter less some charges. Now the forfeiter presents this bill of exchange to the importer banks on the maturity, and the importer makes the payment of this bill of exchange on maturity. This is known as the forfeiting. The difference between forfeiting and factoring, first difference is the factoring always give short-term credit. Maximum is 150 days. Whereas in forfeiting, when we are talking about the forfeiting, the credits are given on medium to long term basis. Second difference is when we are talking about the factoring. Factoring can be done on domestic as well as international trade, whereas in forfeiting it is done only in international trade. Clear? Clear, everyone? So this is the forfeiting. This is known as what? Forfeiting. And third difference is in the factoring, up to 80% of the value is given by the factor agency to the seller. Whereas here, the 100% of the invoice value is given as the payment or as the credit to the exporter. Clear? So these are some of the basic difference between the forfeiting and factoring, right? Clear? Okay, and always remember the minimum size for forfeiting transaction is typically around $250,000. So forfeiting is not done for any short term transaction. Forfeiting is not done for short term transaction. Forfeiting is done for long term, or for long term credits is given, and then the amount which is involved in forfeiting is actually very substantial. It is actually very Break, right? Forfeit is defined from the word forfeit, right? Which means I'm surrendering my rights. Now, this process involves immediate flow of cash while transferring the risk of non-payment. A forfeiter means it is always without recourse. In forfeiting, fourth difference is in factoring, it can be with recourse or without recourse, both. But here, it is always without recourse. So this is the difference between forfeiting and factoring. Very important. Forfeiting short-term credits, factoring short-term credit, forfeiting long-term to medium-term credit. Second, if we talk about the factoring, it can be done on domestic and international trade, whereas forfeiting is done only on international trade. Third difference, factoring. In factoring, so only 80% of the value is given as a credit. Okay, rest 20% is settled after receiving the payment. Whereas in forfeiting, up to 100% of the invoice value is given for the credit. Fourth is in the factoring, it is with and without recourse both. But if we talk about the forfeiting, it is always without recourse. Clear? Done. Now, last thing is threats. Threats is trade receivables discounting system, and it is a platform where there is only the seller who is the micro, small, and medium enterprises. So if micro, small, and medium enterprises are the sellers, they have a lot of invoices which are raised on its buyer, and then MSME want a immediate credit support, then they can register themselves in a trade receivable discounting system where are different financial institution and bank which are present as the discounting agency. There is MSMEs who are only the sellers and there are buyers, right? And in this platform, the MSME just give what? Just give the invoices to the banks for discounting, and then later that bank collects it from the buyer, right? And if we talk about the threats in this platform, it is always without recourse. It means that when MSME is giving you the invoices, the bank the invoices under this threat platform, always remember, if the buyer defaults on payment to the bank or financial institution, then that bank and financial institution should have to bear all the loss by themselves. They cannot demand repayment or reimbursement from the seller, which is only the micro, small, and medium enterprises. Clear? So this is the chapter. I have given you the most important thing related to this chapter. Let's talk about some practice question. The very first practice question is, factoring is facility for which of the following? Factoring, maintaining of sales ledger, maintaining of receivables, debt collection, or all of the above. Factoring is a facility for which of the following? Everyone please answer this question. Factoring is an agency for which of the following? You can all answer this question, everyone. Factoring is a facility for which of the following? So if we talk about the factoring, factoring is a facility for, yes, it is for sales ledger, it is for receivables, it is for debt collection. So all of the above is the correct answer. It is for all of the above. Now, a forfeiting undertakes to execute a specific forfeit transaction at a firm on a discount. What is the fees for undertaking known as? When the forfeitors give you the commitment that I will execute this transaction, I will forfeit this transaction. This is from a particular fees which is known as, sorry, this is from a particular fee which is known as what? And this is for a particular fee which is known as the commitment fee. Clear? So this is the chapter. I hope that you have all understood this chapter. But see, if you want to study the complete chapter, this chapter is very lengthy. I have just given you the most important thing related to this chapter. But if you want to learn this complete chapter, you can enroll yourself in any of these ongoing batches, right? There is a JIB Foundation Batch 2.0, there is a DBF Selection Batch, there is a normal JIB batch. We are coming up with the Selection Batch also, which is starting from 17th of January. We have MCQs batch, we are coming up with the Crash Batch, we have coming with the Crackers Batch, we are coming with all these batches, right? Now, you can learn each and every detail of the chapter by enrolling yourself in any of the batches, right? But instead, you just buy each and every batch individually, just go for this JIB Super Elite all-in-one subscription. When you are going for this Super Elite subscription, you will get the access of live classes, mock tests, notes, AI analysis tests, special previous year sessions, numerical based test, special doubt clearing session, everything under one roof. Okay. Now, if you are using this code currently, there is a very good discount that is going on. If you are using this code SPL, okay. So if you are using this code SPL, you will get a flat 50% off on the JIP Super Elite all-in-one subscription. A flat 50% off, right? So now the thing is changed. You just use this code UTSAV. Currently, the thing is updated. You can use the code UTSAV. When you are using the code UTSAV, you will get a flat 50% off on the JIP Super Elite all-in-one subscription. Okay. So kindly go and enroll yourself in the JIP Super Elite all-in-one subscription, right? Thank you so much everyone who have joined this session. And if you have understood whatever I have taught you in the class, just please like and share the video to the maximum you can. And if you haven't subscribed this channel yet, it's a request guys again that please subscribe this channel and press the bell notification icon. Thank you so much. Till then, take care everyone. Bye bye. Thank you so much. Just please subscribe to the channel and press the bell notification icon. Thank you. Bye bye. Take care everyone. Bye guys. Take care.